Welcome to Geojit Spotlight. Geojit Chief Investment Strategist Dr.V.K. Vijayakumar joins us to share his views on current market and economic scenario. Welcome, sir. Sir, US recession fears are again rattling markets. How serious is the possibility of a global growth slowdown, and how do you see the emerging economic scenario?
A serious concern for the markets now is the possibility of a slowdown in the US. If the US goes into a recession, let us say in the next few months or early next year, that will impact global growth also. And that is a major concern for the markets. Now, it is important to understand that the global economy has three growth engines. These three growth engines are: one, the US, two, China, and three, the Eurozone. The US is the largest economy in the world. It is a $22 trillion economy. China is a $15 trillion economy, and the Eurozone is a $17.5 trillion economy. In these three engines of growth, China is slowing down drastically. China has been the fastest growing large economy in the world for 3 decades now. But now China has serious problems. They have serious problems, particularly in the real estate sector. There is a deepening crisis in the real estate sector. 30% of China's GDP comes from the real estate sector. So that is likely to impact growth in China. China's growth this year is likely to be less than 3%. Coming to the second growth engine, the Eurozone, the Ukraine war has impacted growth in the Eurozone. When Russia attacked Ukraine, the West, under the leadership of US and the European countries, declared sanctions on Russia, and then Russia retaliated by substantially reducing the gas supplies to the Eurozone economies. And the Eurozone economies are now completely dependent on Russia for 55 to 60% of their gas requirements, energy requirements. So this energy crisis has impacted growth in the Eurozone. Their inflation is very high. There are even power cuts in Europe, something unheard of till recently. So the growth in the Eurozone, economic growth in the Eurozone also is drastically slowing down. But then US has been growing very smartly. But then during the last 6 months, inflation has become a major problem in the US. And therefore, to counter inflation, they are raising the interest rates. Already, the US Central Bank Fed has raised interest rates by 2.25% this year. The last two rate hikes were by 75 basis points each. Now, when the economy is slowing down, the right response should be to cut interest rates and stimulate growth. But when you have very high inflation, as the situation is now, you cannot cut interest rates. They are raising interest rates. So there's a rising interest rates, high inflation, and declining growth is an unfavorable macro construct as far as the global equity markets are concerned. It is slightly negative. But then there's a lot of liquidity even now in the global financial system. Investors are flush with funds. Therefore, a lot of money is coming to the markets also. So this is the dilemma in the market now. Global economic slowdown, three engines of growth slowing down, interest rates rising, at the same time markets showing some resilience.
So will the global growth slowdown impact India?
Well, India is the fastest growing large economy in the world this year, will be. Next year also, India will be the fastest growing large economy in the world. This year, our GDP growth is projected at around 7.2%. Next year also, in spite of the global growth slowdown, it is likely to be above 6%, 6 or 6.4%. But then when there is a global growth slowdown, there will be a slowdown in global trade also. So when global trade slows down, our exports will be impacted. So there is no way India can be completely immune to the global growth slowdown. So India will be impacted, but then one thing is very clear. Indian economy will outperform. Indian markets also will outperform. As far as growth is concerned, we will outperform US, we will outperform Eurozone, we will outperform other emerging markets, we will outperform China. Therefore, our markets also can outperform. That's why it is important for investors to remain invested and to continue with systematic investment.
What's the short-term market outlook?
Well, it is very difficult to project or anticipate the short-term market outlook. If you look at the performance of global stock markets from mid-June to mid-August, in 2 months, there was a spectacular rally in the market. In the US, the S&P 500, the very important benchmark index, rose by 17% from mid-June to mid-August. MSCI Global Index rose by 14%. In India, the Nifty appreciated by 18.5%. This rally in the markets was largely on the assumption that the Fed will be a little less tightening. That the Fed will be going a little bit slow on tightening the monetary policy. And many experts even believe that there is the possibility of the US Fed cutting interest rates somewhere in 2023, by the mid of 2023. But the latest Jackson Hole speech by the Fed chief Jerome Powell has belied that expectations. Therefore, it is possible that in the near term, there can be a correction in the market because the valuations are high. Particularly in India, the valuations are high. Nifty is now trading at around 20 times forward earnings. If you look at the MSCI India Index, MSCI India Index is trading at around 24 times trailing earnings, whereas MSCI World Index is trading at around 11.5 times trailing earnings. So that means the premium of India is more than 100% to the valuations of the emerging market peers. Therefore, there is excessive valuation in India, but partly the impressive growth in India and the very good resilience of the economy and the expected spurt in corporate earnings justify high valuations, but valuations are high. And when valuations are high, there can be some trigger that can lead to a correction in the market.
Dr. V.K., which are the preferred sectors to invest now?
Well, presently this is a stock pickers market. The ideal strategy should be a bottoms-up approach, not a top-down approach, not coming from the industry to companies, but then looking at good companies to invest, irrespective of which sectors they belong to. And in Geojit, we have our recommendations by the research team. I cannot make stock-specific recommendations. That's why I am refraining from doing that. Details of the stock recommendations are available in Geojit website. In Geojit Insights, we have recommendations of stocks to invest. But then sectors also are important. And among the sectors, the preferred pick continues to be financials, particularly the leading banks, because Indian banking now is in the pink of health. Non-performing assets are at very low levels. So asset quality is improving impressively. And at the same time, we have a very good credit growth also. So improving asset quality and rising demand for credit is a very good combination for the financials, the banking industry. So this segment is likely to do well. So investors who invest in leading financials, particularly in the leading banks, and remain invested for the next 3 to 4 years are likely to get very impressive results. Then another segment is capital goods. India is now on the verge of a capex cycle, capital expansion, because capacity utilization in the industry is about 75%. So capital expenditure is happening. So capital goods industry is one segment which is investable even now. If you look at the performance of capital good stocks, it is very clear. Capital good stocks like, for example, L&T, ABB, Siemens, Thermax, these are stocks which are very firm, very strong even in a weak market. Even when the market declines, these stocks are very firm. So that means this sector is likely to do well. Then there is FMCG, which is doing well, telecom. These are the important sectors. Automobiles is turning around because the chip crisis is behind us. So these are the segments where investors can look for investment now. As far as mutual fund investors are concerned, they should remain invested and continue with the systematic investment plans.
Thank you, sir.